of Australian shares 2025. So just let you know you're videoing forward. So you're not currently on camera. We are considering, and probably will, video question time. So there's another camera over there we may turn on. Does anybody not want to be videoed during question time? You've got to give your name. Well, if you've got a question, please say your name. It helps when we hand out the video later on to a couple of people who are not here today. So Jan's still in New Zealand, and Peter Moore is up on the Gold Coast somewhere. I don't know where. So welcome everybody. I'd like to introduce to you our guest today, Declan Cassidy. Declan, give us at least 40 minutes probably. Who's talking? John. We'll have at least in the vicinity of 40 minutes talking. I'm sure if you've got an urgent question amongst what he's saying, he'll probably answer it. His background is from the southeast coast of
Central Coast, New South Wales.
Central Coast, New South Wales, but been involved in building the Aldi store here in Benalla. He knows Benalla. Been here before. We had lunch at Zeus Cafe today, which was good. And so please feel free to ask a question, write them down, ask at the end, ask during a discussion. So Declan's obviously been in the business, and I know nothing. I'm going to ask some questions if you don't. So over to you.
Yeah, thanks, Malcolm. First of all, I just want to say thank you to you all for welcoming me here today. Thanks, Malcolm, for having me. We've been going around Australia and presenting to the U3As about fixed income. The last 24 to a little bit over 24 months, there's been quite an attraction towards fixed income with the raise of interest rates. So we're seeing a fair bit more flow come into our desk. Overseas, most portfolios, there's always a 60-40 rule where it's 40% bonds, 60% equities, but due to Australian property and Australian shares, it's always just been property and shares. They've done really well for us over the time, but I think we're getting to a point where there's new financial products that are popping up everywhere, and it's in light of diversity, it's always good to have a spread.
Just a bit of. Can you hear down the back? Right.
Okay, yeah. Just tell me if I need a shout. Let me know. Just a bit of housekeeping. This obviously isn't financial advice. Anything I say is an opinion of my own, not necessarily Fixed Income Solutions or our parents' business. As Malcolm said, if there's any questions along the way, please do shout out. Fixed income, I don't know if many people know much about fixed income here, but if it's completely new, it does take some time to grasp the concepts. I'll try and keep it relatively short and basic, but like I said, just shout out if you have any questions. Next slide. So I'll start off introducing my business and our parent business. I'll go over some fundamentals of bonds and introduce the asset class. And then ultimately, there's three things that investors really care about. It's what does it yield, or what's the return, what's the risk, and does it fit in my portfolio? So I'll cover all those three things, and then I'll go over how you can invest in bonds if it is something that's of interest to you. Unlike shares, the bond market doesn't trade on an exchange for the most part. There's government bonds that do trade on the ASX, but the vast majority of corporate bonds are traded in what we call the over-the-counter market. And like the old days with shares, you need a broker in order to access that market. And then, a bit of a discussion at the end if there's any more leftover questions. Aaron? Right, so our parent company is a company called BGC. They're the largest interbank broker in the world. It was founded by a guy called Bernard Gerald Cantor in 1945. You guys might be familiar with the name Cantor because they own a business called Cantor Fitzgerald over in New York. Cantor Fitzgerald is well known. They occupied the top 5 floors of the World Trade Center back in 9/11, and they got wiped out. 650 employees traded with the past in that event. And then the CEO, well, ex-CEO now of talk a little bit about that in a second. Got together with some other investors and built the business up from the ground up. We do a charity day every year where we donate all of our revenues on a single day, and we give it to disaster relief charities and things like that to give back to the tragedies that happened on that day. So our CEO, this is a little fun fact, Howard Lutnick has he's not our CEO now, he's just joined the Trump administration as Secretary of Commerce, and he will be spearheading the tariff talk, which is hopefully does a good job, because at the moment it's a bit, I'm sure he was a fantastic individual, but there's obviously a lot of uncertainty in markets right now around tariffs, and it'd be nice to get some calm in that area, but yeah, we'll have to wait and see. BGC's business is listed in New York. Here in Australia in 2016 to service a bit of a different market. Our clients are private clients like yourselves, charities, aged care centres, small corporates, things like that. Really anyone that is looking for a defensive allocation in their investment portfolio. We've got 12 people front of house and then about the same in middle and back office. But we rely on BGC's compliance and legal and cybersecurity departments for all of that. We have our own Australian Financial Services licence, and it's important to note we only work with wholesale or sophisticated investors as per our AFSL. Okay. Any questions about our business before I get into the bulk of it? No? Okay, great. So what is a bond? I always like to start this by saying, put yourself in the perspective of you become the bank and you're lending to corporates or governments. So bonds are effectively tradable loans where you're lending money. Unlike shares where you're investing in the company and you're buying a share of the company, you're just becoming a lender to the company. And for lending your money to that company or government, you will get paid an interest rate over a certain time period, and at the end of that time period, you will get the principal payment back. So bonds are issued at a price of 100, and let's say, for example, they have a maturity in 5 years. You will get $100 back at the end of the 5 years, assuming the company doesn't go bankrupt. In between those 5 years, there will be fluctuations in the price of the bond, which I'll get into in a little bit, but rest assured, if you buy a bond today in the primary market at 100 and it pays 5% interest, for example, for 5 years you'll get $5 a year for every 100 until the 5 years, and then you get your money back. So it's capital preservation is front of mind with bonds, which is why they're considered a defensive asset. The types of organisations that issue bonds, I'll just skip forward to the fourth point a little bit, is governments. Governments raise debt to build roads and whatever they need to do. Semi-governments, it's the same. And then there's corporations, mainly banks and insurance companies. You know, banks borrow money from investors and then lend it out. You know, they borrow at 5 and lend it out at 6, and they make their net interest margin. And it makes up a big part of their capital stack for their funding sources. And there's other corporations like Woolworths, Coles, some infrastructure assets and utilities companies. Sometimes they need to raise money to go and buy another business or to expand their businesses. So effectively, bond issuers are...
It's my heart long run.
Yeah, bond issuers are anyone that's large enough to need some sort of funding. It's just an alternative source of funding to equity, and it's about 4 to 5 times the size of the share market, so it's a big deal. There's two main types of bonds, same as a mortgage. There's fixed mortgages and there's variable mortgages. It's the same in the bond market. There's fixed rate bonds and variable bonds. So for a fixed rate bond, it's as simple as the issuer comes to market, almost like a bond IPO. It's not technically called a bond IPO, but we'll use that for simplicity's sake. They might issue a bond at a price of 100 and an interest rate of 5%, and then that won't change over the life of the bond. There's a legal obligation of the issuer to pay those interest payments over the life of the bond, unlike a share dividend, which is discretionary.
Question.
Yes.
Okay, I buy some bonds, but you said if a company goes broke, I lose. Why aren't they insured against? Why isn't the company being forced to insure for solvency?
There are some there are some insurance against bonds. They're called credit default swaps, but that's probably getting a little bit too complicated for this session. But it's not like you won't get 100% of your money back. You might recover some of those funds. So basically what happens is the company liquidates. They've got a bucket of cash. Who do they pay? Well, they're going to start with their senior bonds, or if it's a bank, they're going to start with their depositors, term deposits and cash accounts and everything like that. And then they're going to go to their senior bonds, and then they're going to go to their subordinated bonds. And if there's any money left for equity, the equity will get some money at the end. We'll talk a little bit more about that in the risk slide. But does that answer your question?
Yep.
Yeah. So floating rate notes, like a variable mortgage, there's a base rate. In Australia, we use the bank bill swap rate, which is also called the BBSW, and that's the rate at which banks lend money to each other in the interbank market. And then the floating rate bonds will have a margin above that BBSW rate. So that will obviously fluctuate with market interest rates. Like if the RBA cuts rates, for example, and floating rate bonds will, if they cut by 25 points, then rough numbers, they will cut by, the income will cut by 25 basis points. And then you've got inflation-linked bonds, which have a price and coupon that's indexed to inflation. So effectively, if you ever get quoted an inflation-linked bond, you get quoted a real yield. So it might be 3.5%, for example. You know that you will get paid 3.5% above the CPI rate over that term. Typically, the market uses the middle of the RBA's band at 2.5. So obviously they're quite attractive. There's not that many of them in Australia, to be honest, but they are very popular because everyone wants to maintain their purchasing power and earn something above inflation. Okay, I think I've already talked a little bit about bonds and shares. I know that I'm at a share group, so I'm not here to talk badly about shares or whatever. I'm obviously a shareholder, but it's useful when describing the differences between bonds and shares. So, like I said earlier, equity or shares are a permanent form of capital for an issuer. There's no maturity date. Coupons are, dividends are discretionary as per management's decision. Whereas bonds, you don't own anything in the company. You might own some of their assets indirectly through security, like when the bank takes security over your house in a mortgage, but you don't actually have a share ownership in the company. Your coupons are a legal obligation, and there's a defined maturity date. So your lending is finite rather than permanent for the company. Any questions? No, we're good. Next slide, please, Malcolm. Okay, so here are the key terms. Yield effectively is your overall return, and this is the number that you should really be focusing on. Overall return incorporates any capital gain or loss, as well as any income payments along the way. If you buy the bond at 100 and it pays a coupon of 5%, and you hold until the maturity date I always use the example of 5 years, then your yield will be 5%. If, however, you buy a bond at a price of 101 in the secondary market where it's actually traded after it goes IPO, then the bond will ultimately get redeemed at a price of 100. So you'll incur a capital loss of $1 there. So therefore, your yield will actually be lower than your coupon rate. I'm going to talk about this a little bit more as I go through the presentation, because it's a fundamental characteristic of bonds where yields have an inverse relationship to their price. So if you ever hear in the news that government bond yields are falling, if you don't know about bonds, you would initially think that the value of the bond is decreasing, but that actually means that the price of their bond is increasing. So always remember, capital price and yield have an inverse relationship. It's okay, I'll continue to elaborate on this as I go through. Coupons, that's what the interest is called. I probably should have said that a little bit earlier, but your interest payments are called coupons, literally because back in the day, I think it was 1800s when bonds first came out, it was a piece of paper with some coupons at the bottom, and you would tear it off and go to the bank, and then they would give you money in return for your coupon. Obviously that wouldn't fly today because there's photocopiers and things like that, but that's where it comes from, and that's why they continue to call them coupons. Capital price, that's effectively the market value of the bonds. They, like I said, they're always issued at a price of 100, and then they will fluctuate in the secondary market depending on what's going on with market interest rates. There is another price that I haven't got up here called the gross price, which is the capital price plus the accumulated interest that you've accumulated along the way. Because, for example, if the bond pays coupons every 6 months and you only hold the bond for 5 months, well, you're not going to get paid your coupon on the ex-div date, you could almost call it. So you need to get compensated for that accumulated coupon, and that's reflected in what's called the gross price. So it's capital price plus whatever accrued interest that you've got along the way. Running yield, this is familiar in the equity market. It's effectively your annual income. It's just the coupon divided by the price at which you paid for the bond. Credit rating, we'll talk about this in the risk slide, but effectively there's 3 credit rating agencies, Standard & Poor's, Moody's and Fitch, which analyse the credit health of issuers and how likely it is that they will pay interest and return principal at the end of the term of the bond. And they will effectively assign a rating from AAA right down to D for defaulted, and this effectively just puts a label on how much risk that bond is. So most bonds in the larger primary market with governments and big corporations will have a credit rating. Some of them don't have a credit rating, at which point you need to do your own analysis or rely on people like us or your financial advisor to do the analysis on those assets. But I'll talk more about that, and I've got a nice little chart that depicts the risk in the next slide. Capital structure, I'll also talk about this in the next slide. That's where I was talking about if a company goes into liquidation, they've got a bucket of money, they're pouring it into their capital structure, and if there's any left at the bottom, I'll talk about that in the next slide, but that's what the capital structure is. It's effectively where does your asset sit in a company's capital stack. Fixed coupon, floating rate, inflation link, I've already talked about those, so that's pretty much it for this slide. And this forms the foundation for the rest of the presentation. I'll now get into the risk and some of the products, and then I'll go into some asset allocation. Yeah, thank you. Okay, so like I said, there's 3 credit rating agencies. This one in particular is Standard & Poor's. They're one of the big 3s. They run an analysis on the probability of default for each credit rating for their bonds over a certain period of time. They actually do the analysis from 1 year out to, I believe, 30 years, but I've chosen a 5-year time horizon just because it would be too big if I included all the charts. On the x-axis, you've got the credit rating, starting from AAA down to CCC. D is defaulted, so that means the bond is dead. And then on the y-axis, or the vertical axis, it's got the probability of default. Now, default means a missed coupon. It doesn't necessarily mean that the company has gone under. So if they miss a coupon, that's technically an event of default. They might then go and issue shares to pay bondholders the next week. So they may recover after this. It's just important to know that it's not the company technically going under, it's just coupon payment. There's 2 groups here that you need to focus on, and there's a big distinction between the 2, as you'll see. The investment grade space is considered very defensive in nature. Large governments, corporations, funds will all have mandates of how many assets they can hold in each bucket of investment grade. As soon as an asset gets downgraded into this red line, which is what we call sub-investment grade or BB+, a lot of funds have to liquidate those positions because it falls out of their investment mandate. They just become a lot riskier. As you can see, once you get into the red, and then when you get into up to single Bs, the risk of missing a coupon payment over 5 years starts to get above 10%. So if you think about it, the big funds and governments don't really want to take that risk, so they often offload the assets, and then the prices of the bonds typically fall. Now, this when you're in the double Bs, we do a little bit of work there for the adventurous and the ones that want to capitalise on lower price bonds. It really just depends on the whole portfolio and what it looks like. But for the most part, those that are getting into bonds at the start, you'll typically stay within the investment grade space, which is the blue line. And something that's really important to note is here is an Australian government bond, for example, is AAA rated. And then here, A- is where NAB, Westpac, CBA, ANZ issue subordinated bonds with a rating of A-. And the difference between A- and AAA, as you can see, is pretty small, which signifies how strong the Australian banks are in terms of their credit health and their reputation globally. And these bonds that are A- rated are still yielding decent returns, as you'll see in the next slide, of north of 5%. Now, how do they analyse that risk and assign the rating? Well, there's a lot of work that goes on, but a key thing that they do base it off is where they sit in this capital structure. So this is the bank's capital structure. As you can see, term deposits sit at the top here, and then you've got senior unsecured bonds, subordinated bonds. I don't know how versed you guys are with the recent APRA regulations around they want to get rid of AT1 hybrids and effectively move them into this space because they believe that hybrids are too risky and retail investors don't understand the risk. And then you've got hybrids and then equities at the bottom. So like I said earlier, this is the priority of payment in liquidation, and where you sit on this capital structure depends on what your return is going to be and what your risk is. Like return deposits, now that the RBA has cut rates, you're looking at about 4.85%. Senior unsecured bonds are between 4.85 to 5.25, and then subordinated bonds are 5.25 to 5.75% return. Hybrids, 6.5 fully franked, and then equities, I think it's around 7% dividend yield at the moment, fully franked. I'm not 100% sure. I'm fixed income, not equities. So, yeah, that's pretty much it for risk. Happy to move on if there's no questions. Right, so product and returns. Have you guys talked about hybrids yet? The APRA regulation? Okay. So effectively, APRA is the Australian Prudential Regulation Authority of Australia, came out and said that bank hybrids are too risky for retail investors. We want to get rid of them, and over the next 7 years, they're going to roll them out, eradicate them from banks' capital stack, and they're going to tell them to raise money in equities. 0.25% of their capital ratios will be in equities for big banks, and then the rest is going to be in this space called subordinated Tier 2 debt. And this Tier 2 space is really where we see the sweet spot for investors, because they typically have an investment grade rating, they rank higher than equities in priority of payment, and they still offer a high yield above term deposits. Plus you can lock in yields north of 5% for 5 years, 10 years, whatever it may be. So the types of organisations that issue sub debt is what we call it, or Tier 2 debt, major banks, insurance companies. They are defensive, they are often investment grade rated, and you would be familiar with most of the issuers that are issuing Tier 2 debt. They're actively trading in the secondary market. Sometimes they're issuing about $1 billion, sometimes $1 billion worth of these bonds at each issue. So they're actively traded, and they trade in parcels as low as $10,000. So then you've got senior unsecured and senior secured bonds. This is a wider range of yield to maturity, because sovereign bonds or government bonds are typically they're technically senior unsecured bonds, but they're not really unsecured because you're effectively secured by the strength of the government. They hold zero credit risk. Yeah.
Oh, for the purpose of the camera, Malcolm, because you're a worldwide organisation, and we're talking bonds here, are all these bonds you're talking about in Australia, or some of these bonds on the US market or the European market?
Good question. These are all Australia, but that means that they absolutely are overseas. the global bond market is far larger than the Australian bond market. So they might call them differently. They might not call them tier 2 or sub-debt. Sometimes they call them senior or junior preferred or something like that. But yes, absolutely, they are. They do exist overseas. And about 30% of our business is done in foreign currency. At the moment, it's a little bit not encouraged because the US dollar is so strong, but we do hold a whole lot of US assets in our clients' portfolios. So yes, senior unsecured and senior secured bonds. So at the lower end of the spectrum, you've got government bonds, which could give you around 4.3%, a little bit higher if you go out further. And then on the other end of the spectrum is senior secured bonds, where this is quite a popular part. It sort of ties into private debt and private credit, if you guys are familiar with that. But effectively, this type of bond is secured against some sort of asset or some sort of cash flow. So, for example, if I am the investor and I am lending to this company, then I will take security over their property as a first rate registered mortgage. If something goes wrong and they can't pay me back at the end of the term of the bond, then I effectively take the title of the asset. Our bond trustee takes title of the asset. It's effectively in the investors' names, and they'll work to liquidate the asset to pay investors back. So it's a way to secure the investment. Yep.
Les Rogers, I've got a question.
Yep.
Nowhere has there been any mention of debt equity relationship.
Yep.
And that's pretty important when it comes to bonds.
It is
When
important.
I first started buying bonds, I was given a talk by a company, and one of the things they said, Qantas is really good to buy because it's got all these aeroplanes.
Mm-hmm.
They go belly up, they can fly the aeroplane.
Yep.
So thinking about that, I bought a bond which was a Virgin bond.
Yeah.
And I don't think Virgin even owned their photocopiers. And they eventually went belly up and got very little.
Yeah, it was.
So debt equity is very important.
Very important, yeah, and that's where the ranking comes into it. You want to have first registered mortgage with the Virgin bond. I believe that was senior unsecured, not technically secured against the assets. I'd have to double check that. Were they secured? I'd have to double check that, but that was a terrible day for the Australian bond market. Who would have thought that Virgin Australia was going to go under? But they did, and that did happen. So yeah, it's very unfortunate. The type of senior secured bonds that I'm talking about is ones that we originate ourselves, where we take security over a property, and we actually have a lot more control than investing in a larger company where there's thousands of investors that are all involved in the process of trying to recover some funds if something goes wrong.
Because it wasn't helped by COVID at the time, and the Australian government propped up Qantas and left Virgin to make their own rate. I
know, which isn't really fair, is it? And there's still Qantas bonds out there that are trading at pretty low levels, so they still see that. And the reason is because the government didn't help them out. But it was a terrible day in the Australian bond market when that Virgin stuff happened. It was a chaotic time. And then we've got corporate bonds and corporate hybrids. These are places like Coles, Woolworths, Ampol, AusNet. Corporate hybrid space is trying to take over that bank hybrid funds. There's about $40 billion worth of bank hybrid money coming back over the next 5 to 7 years. So there's all sorts of investment places trying to grab those funds and find alternatives for major bank hybrids, and corporate hybrids are one of the places that those funds will go to. And then private debt and private credit. We don't directly do private debt and private credit. This is the space of non-bank lending. So if you can imagine a borrower like a property developer needs to settle on a property within a short period of time, and a major bank can't do their analysis on the borrower in a timely fashion where they will miss settlement, then they have to go to this big area that's growing massively globally called private debt and private credit, who can provide borrowers funds really quickly but at very high interest rates. So these are in the ballpark of 8 to 12%, sometimes wider than that. And if you're looking at getting into this space, you must be very careful because there's a lot of small places that are popping up. You need to do your analysis on who you're lending your money to, and they look really attractive from the outside. And it is a very attractive space in the market. We've raised capital for these businesses that are lending out to borrowers that can't get funding from the bank, and touch wood, we haven't had a loss since we've started originating this debt. But we work with a very select few financiers that we know their businesses very well, and we structure the bonds in a way that they're set up in a bankruptcy remote trust vehicle. And if something goes wrong, we can step in and have a lot of control in that space. Okay, so what affects returns? Underlying yields. Corporate bonds are priced based off government bond rates plus some sort of margin, which is what we call the credit margin. That margin will be made up of a liquidity premium, a maturity premium, and a default risk premium. Effectively, if you're going to lend money to a corporation over a government, you need to get paid an extra amount because you're taking more risk. There's a chance, if you're lending to NAB, for example, there's a chance, very low chance, that NAB will go bankrupt in the next 5 years, for example, opposed to a government where technically they can just print money to pay people back. So effectively they have no credit risk, but every bond in the market is priced off this government bond rate, which fluctuates based on two things: inflation and GDP. And then they obviously are affected by things like the new president in the US, COVID, tariffs, strong employment numbers, putting money into everyone's pockets, the older generation spending all of their money because they're too rich, going on holidays.
We're not rich. We're not rich.
Oh, I don't know about that. There's a big transfer of wealth that's about to happen. I can tell you right now, the young aren't spending their money. Well, they are, but yeah.
You didn't have to pay 17% interest rate on your home loan.
That's the first thing I always hear when I talk about this. But you're all wealthy with houses that are worth gazillions of dollars, and we can't get in the market. So the government bond rate, I'm joking by the way, the government bond rate is determined by, particularly the 10-year government bond yield is determined by real GDP plus inflation. That combination is actually nominal GDP. So different market forces cause these to fluctuate, and therefore they also affect the corporate bond rates because they're priced off the government bond rates. For example, if government yields fall, then you should see a rally in corporate bond rates and government bonds as well. That's the inverse relationship of yield and price. Government bonds fall, yields fall, their price will appreciate. So if you ever see in the news that government yields are falling, it means that they're actually appreciating value. And that's what you want as a bond investor for fixed rate bonds. Market sentiment, this is the same with equities. There's two things that drive market returns. There's fundamentals, and then there's market sentiment, or vibe, or whatever you want to call it. Right now, equities are just, it's the biggest bull market I've seen. Obviously I haven't seen many, but it seems every day I walk into the office, the S&P 500 is hitting a new record, and US stocks are just going nuts, and Nvidia's posting new profits, although who really knows where AI is going to go. It's not their fundamentals aren't necessarily amazing, like their earnings per share, etc., aren't necessarily amazing, but there's so much excitement about buying US stocks at the moment that their prices just inflating. That's really driving a lot of the rally in the share market. It's the exact same in the bond market. If the market is saying or thinking or expecting that inflation is going to come down within the band and it's going to moderate, then you will see a rally in bonds because bond yields will fall with that. So it's it acts the exact same as the equity market, in that the sentiment plays a big role in what drives returns in the bond market. Credit margins. I think I touched on this earlier, but so credit margins is that extra, the premium that investors demand above lending to the government for zero credit risk. If, for example, right now, the economic conditions of banks and corporates, particularly in Australia, is really rosy. So investors aren't demanding that much more extra above the government bond rate. It's, for a bank at the moment, you might get 1.5 to 1.75% above the bond rate. If, for example, economic conditions started to suffer and... Oh, okay. Is that going to continue to go, or is that fine?
No, it'll stop.
I can stop. I need a drink anyway. Credit margins it determines, how much extra investors demand for lending to a non-government issuer. So if, for example, we were to go into a recessionary environment, you would expect credit margins to widen because you would expect corporations to post less profits and they wouldn't be as healthy. So investors would demand more for lending to a non-government issuer. At the same time, yields wouldn't it wouldn't completely blow out, because at the same time, if we did go into a recessionary environment, then what you often see is equities sell off and risk assets sell off, and then that money still needs to be invested. So they go into government bonds as a safe haven asset. You also see funds go into gold. There's some market participants that say that Bitcoin is a safe haven asset now. I don't know about that. I'm not an expert in crypto, but it doesn't really sit with me as a safe haven asset. It's too volatile, and from memory, it didn't do very well in COVID. So I can't see how it will be a safe haven asset, but there are people out there that believe that Bitcoin is safe haven. But for the sake of this presentation, you do see flows that go into bonds, and bond yields will fall, aka their price will rise in a recessionary environment because people flock to safety. So you might, why I say that is you might see credit margins widen, but at the same time you might see government bond yields fall. And because corporate bond rates are based off the government bond yield plus the credit margin, you might not actually see that much of a difference in the overall yield. Might be getting into the weeds a little bit there, but yeah. What else? Credit upgrades and credit downgrades. Obviously, if the credit rating agencies who are analysing the risk of the bonds, if they downgrade from BB minus to BB plus, then the price is going to fall. And the same goes the other way. If they get an upgrade or if their credit health is better, then the price is going to go up. And then regulatory changes, like what APRA's done with the bank hybrids. Effectively, what happened there was, because APRA came out and said the banks, you can't issue it, we want you to move the hybrid money into subordinated debt. I can't get into hybrids too much in here because it'll get a bit too complicated, but effectively that de-risked hybrids and they appreciate in value. The reason they de-risked is because now they effectively have to be redeemed.
This is a truck now.
Oh, is it? Yeah.
It's not a truck.
That pretty much covers what affects returns in a macro view. There's other things that are in play, but by and large, it comes down to what the economy is doing, what inflation is doing, what growth is doing, how healthy corporates are, what's going on with regulation, what's going on with geopolitics. So as you can imagine, right now it's pretty uncertain times, but luckily enough, bond volatility is far less than equity volatility, just because they're defensive assets. That's it for this one. Right, so this is just a chart. On the x-axis is your risk, and on the y-axis is your potential return. It's just a basic risk-return chart. Cash at the bottom, obviously, it's guaranteed by the government up to 250k. Then you've got fixed income, and those two make up my world. As you can see, they are the most defensive assets on this chart. Then you've got your property, depending on where you bought. It's been doing pretty well I don't know what the compounded average return over the life of 20 years is, but I believe it's better than fixed income.
But there's an old rule.
Yep.
It's called the 7-10 rule.
Okay.
Right. So if you're earning 10%, you'll double your money in 7 years. And conversely, if you're getting 7%, if you're getting 10%, you'll double your money in 7 years.
Yeah.
It's called the 7-10 rule.
It's compounding interest is the seventh wonder of the world, isn't
Yeah.
it? So this chart it's not rental yield on property, it's overall yield, because rental yields at the moment, I don't think that are very good. And then shares and alternative investments like private equity, private debt, venture capital, things like that. The way that I like to think about this chart is, if I'm getting 7% on a balanced fixed income portfolio, then I probably want to be getting 14% on my share portfolio, which is happening right now in the US. Just from a risk reward perspective, I think that's a pretty good metric. In terms of asset allocation, I mean, there's a rule out there that some people abide by. Everyone's personal situation is different, but some of the market says that you should hold 100 minus your 80 in equities and then the rest in bonds. So if you're 80, then you should have 20% in equities and the rest in bonds. Like I said, it really does come down to your personal situation and how conservative you want to be, where you're at in your life, whether you're looking for capital preservation or growth. Obviously in shares, you can still get capital preservation in your blue chip Aussie names like BHP, CBA and the like. But the role that bonds play in a portfolio is you're not looking for any upside. You're looking to earn income and preserve your capital. You're not looking to earn alpha. Whilst you can with falling yields or tightening credit margins, it shouldn't be front of mind. It really should come down to, I want to preserve my capital and earn income and know what income I'm earning along the way, because it is fixed and it is known. So that's really the role that bonds play in the portfolio. And I believe that concludes the education side of things. Just a bit of housekeeping. If you did want to learn more, there's a contact submission form on there. There's obviously no pressure. It's just if you wanted to get my market commentary or have a chat to me later on in the week about your own situation, how bonds can fit the portfolio, I'd happy to have a chat. Just fill out that form and I'll get in contact. There's two ways to invest through us. We're not a fund, so nothing is unitised. You have direct ownership of every asset you invest with through us. We're just a broker, so you're actually buying directly the assets. There's self-directed, where I work with you, but you will ultimately make the decision at the end of the day. We don't have any ongoing administration fees. The way that we make money is through the bid and offer spread. So for example, we might buy the bond in the street or the institutional market for 6%, and then we'll offer it to you for 5.9%, and then we make that 10 basis point margin. That's where our revenue comes from. From there on out, we don't charge you anything. The size of that margin is based off the length of the bond. For example, if you're buying a 10-year bond, we need to analyse the credit health of that bond for 10 years. We need to administer your coupons for 10 years. And we also need to pay the cost of holding your bonds in what's called a custody account. So it'll be more expensive for a 10-year bond over a 5-year bond, for example. But a basic rule of thumb is it's between 5 and 15 basis points off the yield. If you wanted to hand the keys over and let someone else manage your bond portfolio, we have an individually managed account, which is completely run by our PM. But your investment man, you work with him to establish a set of investment criteria that he will abide by over the time that you're invested with us, which can be changed over time. For example, it might be, I want 100% investment grade bonds, or I want 100% banks and insurance companies, no coal, gas, no tobacco, for example, or I want a weighted average maturity of 5 years. All of that is established at the start, and then you hand over the keys and he goes and manages your account for you. But key point, difference between a fund is you maintain the ownership of the actual assets, which is important, particularly in times of stress. Yeah.
Can you hold bonds in dual names?
Yep. So the types of absolutely. So the entities that we typically work with is either individual or joint account, self-managed super fund, family trust, corporation, or some other trust. So yeah, you can invest out of all of those entities.
Okay.
Yeah. Yeah. That's
Have you got time to explain the difference between the various kinds of inflation-linked bonds?
Yeah.
And there's capital index bonds, there's variable coupon bonds.
So
And a lot of them put money back into the capital again as well.
yeah, so for example, starting with capital index bond, there's one well-known capital index bond in the Australian bond market issued by Sydney Airport.
Yeah, that's one that I'm thinking of.
Yeah, I believe it was issued at a price of 100 in 2005. And the way that bond works is its capital price or its market value appreciates based off the inflation or the CPI number of that period. I think it resets every 6 months. Don't quote me on that, it might be every 3 months. So if, for example, it's issued at $100 in 2005, let's say CPI was 2.5 that year, then the price at the end of the year will be $102.50. And then it keeps going up and it keeps going up based off the inflation rate over that period. So the price actually appreciates. Those bonds are now trading at around $161.
161,
Yeah. So they've had their price compound and grow with inflation over the period. And then they also pay a coupon rate, 3.12%.
3.12%.
Yeah, 3.12%, which is was the real yield at the time. And when you get quoted these bonds, you'll get quoted the real yield, which is your yield above inflation. The other type of bond that we actively trade in our business is inflation annuity bonds. So it's actually pays down a base annuity over the life. So they're trading at starting at 100, and they're trading at about 68 now, I think. And that price will eventually pay down over the life of the bond. So it's amortizing as well as having coupon payments and principal linked to inflation. Yeah.
The other one is the variable coupon one. I've got Commonwealth Bank.
Yeah.
6.12% variable coupon.
So the inflation
there's some
one?
relationship between the inflation index and which is unstated. I don't know what it is.
I don't have a lot of experience with that bond, so I don't want to give you any false information. We only do capital index and IABs, inflation annuity bonds. We can do that bond. It's just not one that we've got much experience with. Actually, that's not true. Some of the other guys at my work might have experience with them, but I don't. So I don't want to give you incorrect information. I've actually, I think I know.
Banks. Westpac's got the same thing.
Variable coupon bonds. So they're not a floating rate bond.
They're sort of.
Well, in a way, CIBs are. I guess no, they're not really variable coupon. Yeah, I'm not sure. I can look into it and get back to you. Yeah. Sounds interesting. 6.125 for a CBA bond sounds pretty good.
Yeah.
All right. Yeah, that covers my presentation. So I hope it wasn't too technical. It's really hard to introduce a new asset class if you haven't got much experience there. Yeah.
Is there a minimum amount? What's the amount that you've got to invest?
So it depends on the bond, but we always recommend a 50k parcel of each bond. The reason why is if you hold 10k and you want to go and sell it, there's not many buyers that are going to buy a 10k parcel, particularly in the fund space. So if you've got a fund with $1 billion assets under management, you won't go through the administrative efforts of buying 10k, but you will do it for 50. Now, I will trade lower parcels than 50 in particular bonds. In our originated debt, I would do a 10k parcel, but for a NAB bank bond, I'd probably recommend starting with 50k. Yeah.
Is there anything wrong with borrowing a certain amount of money
to buy bonds. I think if you've got your own money as some sort of security, is there anything wrong with borrowing an amount of money to buy bonds?
Well, that's a personal situation that I don't know. I like where you're coming from, and it sounds like you take a bit more risk than the usual punter. But
Okay, yeah.
there are people. Yes, there's a lot of people that borrow money to buy bonds. Yeah, we don't provide leverage, unfortunately. Yeah, I like your thinking. Yeah. I think I'm on time actually. Yeah, what was that? 53 minutes.
Yeah. It's a bit like an auction. Going once for question time. Going twice.
Done. All right.
John? No questions, John?
No?
Third time, all sold.
Thanks again. Yeah, thanks for having me.
On behalf of the group, I hope you found it interesting or confusing, one or other. or a bit of both.
I hope it was confusing because it was completely new. I don't hope it was, but it's normal. It's normal to be confused at the start with fixing.
Thank you very much for coming up here.
Thank you.
And a small token of our appreciation.
Oh, great. Looks like a good call to bed.
Football fan, yeah. We've got gold on the edges. So.
Thank you. Thank you.
Look, like